Wall Street Unplugged looks beyond the regular headlines heard on mainstream financial media to bring you unscripted interviews and breaking commentary direct from Wall Street right to you on Main Street.
What's going out there? It's July 11th, and I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down the headlines and tell you what's really moving these markets. I took my wife to a pretty amazing concert a little over a week ago. I went to go see Poison, along with Cheap Trick. Man, we're old. She's a huge fan of Poison, especially Bret Michaels. If you're a millennial, listen to this. We have a lot of millennial people listen to the podcast, which is cool. Probably have no idea who they are. Cheap Trick or Poison. The Poison's hit song is Every Rose Has Its Thorn, and the whole beautiful song in the 80s and all that stuff. And, yeah, they have a lot of good hits, but I'm sure that's the one you may have heard of if you're younger. And I have to be honest, they killed it. I mean, Bret Michaels was awesome, jumping around the stage, going crazy. His tight jeans on, the cowboy hat, which my wife really loved. I think she was the only woman that liked it because, and I'm going to be perfectly honest here. I mean, Bret Michaels is around 55 years old. So the average age of the crowd was close to that with my wife and I, in our mid-40s. So maybe part of the younger part of that crowd. But the women who went to this concert, again, just over 50 years old, I mean, they didn't look pretty. They were hot. They were sexy, leather pants, hair done up like the 80s, lots of makeup. They were drinking, singing, having a great time. The husbands dressed to impress. It's just really cool to see it, just everybody hanging out, having fun. I tell you, I know for a fact, every guy that took their wife to that concert was pretty happy the second they got home. Because if I had to guess, they definitely got some, which is awesome, right? That age is always cool. Now, their wives, they were probably thinking of Bret Michaels the whole time, but, who cares? It doesn't matter. I mean, as long as, you're fooling around your old age, that's really cool, right? It's awesome. Anyway, it was a great concert. My wife loved me again for a few hours till the kids woke up the next morning. Then I went back to being, I think, the eighth least important member of my family behind my daughters, my dogs, my cat, my snake, my turtle. It's like a zoo in my house. I'm just kidding. We had a really great time. Lots of fun. It was just nice to get away from the kids and just drink and just see like that crowd just having a really great time. And it was cool. But there's a reason why I'm bringing up this story. Because during the concert, usually they come out, this big present, it's awesome, lights everywhere, smoke, everything going crazy, right? A lot of blasting music, and they sing one song, and then they come in and they start talking. Usually say, hey, guys, great to be here. And sometimes I'll mention the wrong city they're at if they're really drunk and everything. It doesn't happen there. But Bret Michaels is just like, hey, after the first song came out, he's like, hey, guys, how's it going? And Bret Michaels was on Celebrity Apprentice when Donald Trump was, hosting it. And I watched every episode when he was on, and I really liked him. He's just like a down-to-earth guy. He's really cool. And Bret Michaels actually won, right? He actually won that Celebrity Apprentice. So he's a diehard Trump supporter. But after singing that first song and then coming out and talking to everybody, he started just telling the crowd and said, look, guys, we're going to have so much fun tonight. We're not going to talk any politics. Just forget about all the craziness we see on TV. And the crowd started going nuts. They went absolutely nuts. Everyone was clapping. It didn't matter. Democrats, Republicans getting along. Oh, my God. Oh, my goodness. It's crazy. CNN and Fox business anchors hanging out with each other. But there's something to be said of that. Because there's a reason why Donald Trump got elected, even though no one in the world, the United States voted for him, right? Nobody would tell you that they voted for him, right? Yeah, which I just find funny. But it's actually pretty simple why he got elected. Everybody hates politicians, and Trump was an outsider. It just happened to be Trump an outsider. You put a different name on him, a different face on him. That person had a great shot at getting elected. And you look at all the stories behind it, the statistics, the data analytics. They knew this was the time for someone outside of that arena to run, and Trump was, that big name at the time. And they said, hey, this is going to be a good idea, and this guy's going to probably win if he runs. Again, all the numbers, all the data supported it before anything what you thought about. Kind of amazing. But if you're a Democrat right now, and you want to run for office, I'm going to tell you what you should do. You should hire me as your campaign manager, because I'm going to show you exactly what you need to win in these two steps. The first one's pretty easy. Just create a new law banning every dog from flying in a cabin of planes. That's first. Seriously, every person that flies who does not travel with a dog hates that. Bring this up personally because it happened again to me for like the 5th time. I mean, they'll move you around the whole plane instead of the person with the dog. If you're allergic to the dog, nobody cares. I mean, they'll put you in the bathroom before they do anything to the dog or its owner. So that's close to 10 million votes right there. I mean, what separation was less than, I think like 2.9 million votes separate Trump and Hillary. I don't know, little rant there, but seriously. I mean, my measure would be to just stop the BS. Stop playing politics. Like trying to tie Trump's Supreme Court pick to the Russia investigation. I mean, come on, enough with this Russia thing already. Again, this has to be funded by the Republicans and just like given to the Democrats like people really care. I mean, the Russia thing, hey, let it go. There's got to be, listen, every Supreme Court, I get it. You're going to grill them. I know it's a big deal. I understand implications of that. But there's nothing you could do. Just like with Obama and I forgot who was retired, who was passed, whoever it was. But, the same thing happened, right? Even with the Republicans. But there's really like nothing. Just find a different way to really maybe attack the person that he's actually going to pick for the Supreme Court instead of just, we're going to tie that to the Russia investigate. This way, this person's going to come in. And we try to impeach Trump. And it goes to the Supreme Court. All this nonsense. It's just, it's just crazy when you're listening to it. And like the diehards on both sides, it's just insane right now. But I don't think they understand that people hate this. It's not what we like. It's not what we want to see. I mean, we want unity. Like if someone comes up with a good idea, no matter what side you're on, what party you're from. I mean, if it's a good idea, it's a good idea. I mean, there's terrible ideas I think Republicans have come up with. Yes, the way we're handling tariffs, absolutely. I think it's great. I think it needs to be done. We could be handled a little better, not being, as arrogant as we are. But look at tax reforms. Are you really going to tell me tax reforms are bad for this country? Everybody's making more money. We're going to have GDP growth, fastest growth we've seen. I mean, outside of like maybe right after the credit crisis and everything, in how many years? We're seeing money come back in, repatriation, everything. More money's coming back to the U.S. We're seeing more equity in homes in history. What is it, like almost $6 trillion in equity in our homes right now, the home values? No, it's not another housing bubble. I'm going to cover that later on. Or think about when you had Hillary and you had Trump on stage and they were asked in almost every debate, what's the biggest threat to America? What was it? They always said North Korea. And we have a president sitting down with, president of North Korea, easing tensions. I don't care what side you're on. That's a good thing. Again, I'm not just playing and picking a few things here because there's a lot of bad things out there. But the people want unity. If it's a good idea, they want to be open to it no matter what party it is. You don't want to shut it down. No matter, I don't care. It came from the Democrats, it came from the Republicans. We're going to shut it down for everyone on the side, no matter what. No matter what. And that's the way it is right now. You can't even hang out with friends who talk politics anymore. At least I can't, because it's a no-win situation that just ends in arguments. If the Democrats just start paying attention to what the people want instead of what, those politicians or what they want, they really have a shot to win a lot of seats in the midterm elections and possibly the presidency in a couple of years. I'm just saying. It's just interesting to see that this is the second time I've been in a big event like that when everyone's like, forget the politics, and everybody just went like, that's what people want. Don't you understand that is what people want right now? Yes, we know Trump could be an idiot. Yes, we know Obama could be an idiot when he was president. But, just the hate that's going on right now is just incredible to the point where, man, I mean, you can't even watch the news channels anymore. It's nuts. It is absolutely insane. I'm just saying. Every time I talk politics, I get a ton of emails, so let me have it. Frank@CurzioResearch.com. I want to move on here because I have a great guest for you today. His name is Chris MacIntosh. He's been in the show probably about 3-4 times now. And every time this guy is on, he shares an amazing idea, something that usually does very, very, very well. Like we recommended Bitcoin at $400 2 years ago. Yes, we know it went from 19,000 to 6,500. We get it, but still at 400, you're looking at 15 times plus gains. Recommending the U.S. dollar 18 months ago. I know, man, you can't recommend the U.S. dollar. The world's going to end. That's bad. No. Did very well in that trade. And shipping stocks as well. Some of his picks performed great. And Chris has one of the best track records of any one of my guest hardcore analysts here that you're going to hear. Okay. It's not going to be so much of the entertainment factor where you get what Jim Cramer's on and sometimes it's exciting. I mean, this is hardcore research. This is something that I love, something that makes you money. But in this world today, people love entertainment. They want to be like, no, the shipping stocks, you got to buy them now, like Cramer. I need you in this stock, ski daddy. No, it's not like that. It's kind of like, here's why I like it. This is my research. Here's how we play it. This is why the market's a disconnect. And you're going to hear some really good ideas in a few minutes. So Chris, the founder of Capitalist Exploits, editor of Capitalist Exploits blog, co-founder of global private network Seraph, travels all over the world to find disconnects in the marketplace. Doesn't limit it to anywhere. It could be currencies, bonds, stocks, commodities, and anything. And during this interview, he's going to share some more of his favorite ideas, including one thesis that's pretty original. Not only that, it's going to surprise you. He's going to tell you exactly how you can profit from it. Be sure to listen to it. Trust me, it's going to be fantastic. Later on the show, my educational segment, I'm going to talk directly to every single person over the age of 55. Okay? So if you're over the age of 55, you need to listen to this segment. Especially if you own any newsletter, not just mine. Because I'm going to share something with you that's going to shock you. I'm not selling this. It's actually going to shock you, but in a good way. And when I tell you this, you're not going to believe me at first. You're going to think I'm absolutely crazy. I'm nuts. I'm smoking something. When I start going over my research and the homework, you're going to fall in love with me. I'm not kidding you. It's going to make you sleep peacefully at night without any worries about your portfolio ever again. Man, that was a great tease. I didn't even mean for that to be a good tease, but I actually mean that. Please, if you're 55 or over, listen to this segment because there's something that you're hearing out there that's so terrible you don't have to worry about. And I'm going to break it down and show you why you never have to worry about this again, at least in our lifetimes. Anyway, before I get to that segment, I want to bring Chris MacIntosh on. He's about to share his next big idea with us. And here's that interview right now. Chris MacIntosh, thanks so much for joining us again on the podcast from, where are you these days?
I'm in Hobbitville, Frank.
Are you
in the land of Mordor?
Did you actually go there for filming and things like that? Or, I mean, it must have been a big event where you are.
Yeah, no, we've kept a home here for a number of years, and it's quiet. It's far away from a lot of the goings on in the world that you don't necessarily want to have going on, and it's easily one of the most, if not the most beautiful country I've ever been to. I've traveled to, I don't know, it's well over 50. I've lived in 7 odd countries, and this is my little personal paradise. So yeah, this is where I tend to spend most of my time when I'm not having to be somewhere else, which these days is more often spending a lot of time researching and just running the fund and the service that I run, which for the most part I don't need to be traveling as much as I used to. So that's a good thing.
No, it is a good thing. And for those of us who haven't seen, which is not me, I saw everything, but those of us who haven't seen Lord of the Rings, where exactly are you?
We're up on the North Island because the South, which actually most of the film was filmed down on the South Island. But we're on the North because it's warmer. It's too cold down there, as beautiful as it is. Mm-hmm. And a little beach community here, which is pretty much the destination for anybody retiring. So we kind of got this weird setup where we have what are new youngish families trying to make a life, and then a lot of retirees. So it's newly deads and nearly deads and newlyweds, I guess.
No, it definitely makes sense. And I'm still waiting for the invite there. So whenever you get a chance, buddy. So yeah. But anyway, let's move on here because Chris,
come on down.
You're not new to this show. You've been on several times. You're probably have several huge winners for us. I mean, we've been talking probably for about 2.5 years now. One of the One of your specialties, right, is looking for disconnects in the marketplace. And it was something that you mentioned to me, and you joked around about it saying, I really didn't invest in it. Like, I think it was like when 20, 25, whatever it was, $30, and it was Bitcoin, but you still mentioned it when it was $400, which gives you, I think, 15 times returns, even at this level, even though it's down 60%. But it was something that you saw that I think you said you didn't really take too seriously at first. And then you're like, wow, this really makes sense. And you're someone who covers lots of industries. You'll go anywhere if you find these disconnects in the marketplace, where I saw you invested in things like cobalt, palladium, solar, shipping, Japanese banks, the dollar. So my question to you to start this off is, what are some of the sectors, markets, economies that you're seeing those disconnects, which fits into your style, that where you see maybe little risk and huge returns on your investment?
Right. Well, if your readers or listeners don't know, I guess I'm not a specialist in anything. I'm pretty useless at a lot of things. What I tend to look for as asymmetry, which is two things, and people tend to forget, when they think of asymmetrical bets, and they think purely of something going up in value, and that's not really the way to think about it. There's two aspects to it, and the aspect which I think people should spend more time considering is the inability or the probability of something going down being very, very low. And so there's kind of two ways I go about this. I've got my head trader who typically will look for markets that exhibit that in some shape or form. And I'm more macro oriented. So I look at social factors around the world. I look at behavioral psychology. I look at history, and I look at the underlying fundamentals of any given market, and I try and piece all of that together. And then when I sit with my trader and team, then I see if any of these setups which he will present to me fit, and try and make sense of them. And where they do, that's typically where we get quite excited and we start digging deeper. There's times when he'll come up with some particular sector which looks fascinating, but we can't necessarily get comfortable about it. And so that's kind of a basic framework around how we go about managing things. And as we talk today, and we've got, dare I say it, a really interesting setup. And I hate to use the terminology, a perfect storm, really just because so many bloody people use it, and it's often for aggrandizing and scaring the living shit out of people, and that's a silly thing to do. It's certainly not a way to manage money. But that being said, what we've been focused on has been a number of things. A reversing of globalism, which we anticipated would begin with a political shift. The fundamentals of the market, Frank, have been pretty shitty, in certainly with respect to the sovereign debt markets. And so you ask yourself the question: why have we gotten to the point of valuations and metrics within the sovereign bond market that we have, which we've never seen in our lifetimes before? And you could easily, 10 years, have made the argument that this is an asymmetric bet to be, say, short the sovereign bond market, and that was a terrible investment. It might have made a lot of sense, but it wasn't the right way to go. And so we keep looking at these things, and one thing that I've realized over the 20-odd years I've been mucking around in this space is that you need to have a catalyst, you need to have a tipping point. And so we've been looking at these bond markets and trying to anticipate what that catalyst might be. And I'd always felt like it was likely to be political in nature. And the reason really for that is, like, if you go back, you look at, we've had this sustained coordination of financial and regulatory policy between countries that had actually made it possible for a couple of events and circumstances. Namely, we had, coming out of the GFC, we had almost like a common enemy. And I made this analogy in a blog post some time back. So if you think about when the Allies went to war against Hitler and the Nazis, it was because they understood that a failure of any one of them endangered all the others, right? So you had this common united front that was not only reasonable, but it was necessary for survival. When the GFC hit in 07, 08, the similar thinking applied. So failure of the US banking system could quite quickly escalate and cause failures in the British, Japanese, European, and Asian banking systems. And everybody, whether that was actually true or not, they fundamentally felt that there was sufficient risk that that was the case. And so the political bodies and those in charge at the time, which I guess we could call them the status quo, they were all deemed reliable and trustworthy. And we relied upon them to do the right thing, which they went ahead and they opened swap lines. They bailed out insurance companies and automakers, and they effectively nationalized certain industries and so on and so forth. So while all of that was taking place, the political language and narratives were carefully managed by the politicians and central bankers across the world. And so that was this environment which actually contained any outflows from the bond market. Now, the largest bond markets are the European, Japanese, and the US, but you didn't have an exit valve. And that was largely because of all of this coordination at a political level. Now, fast forward to today, and this is again something that we've written about quite a bit on the free blog and certainly been focused on a lot, the member activity, but that's not the world that we live in anymore. We've got a rising, what I termed, Trump was one of that, Brexit was that, Salvini in Italy is that. And with that, we're seeing a fracturing of that coordination, if you will. And so it's our belief that it's impossible to have policy coordination when you don't have political coordination, and we don't anticipate we're going to see that. In fact, we're kind of at the early stages of that already. The Fed are raising rates while they're not raising in Japan, they're not raising in Europe, and they're not going to be able to raise in Europe, even though Draghi's come out and said that they will. If you look at the target 2 imbalances in the banking system there, that dog won't hunt. I mean, it's not possible for them to actually end QE without having some of the periphery banking systems implode, Italy, Spain. And so they're sort of stuck in this situation, which is between a rock and a hard place, and that's creating a divergence between bond yields. And so that's the sort of crack, if you will, that we have been waiting for and looking for. And then the other thing that we've been spending a lot of time on is we've been thinking about globalism. And if you kind of think about what globalism has been, it's really just been a de facto importing of very large, low-cost labor pools, much of it from Asia, Bangladesh, Vietnam, Cambodia, China. And what that's done is, to a certain extent, it's hurt the blue-collar workers in Western countries. But importantly, it's also created a lot of deflation, right? So when you bring in a massive labor pool that works for a couple of dollars a day, it increases the supply of any good or service. In fact, it explodes. And if you think about, the cell phones that we use or any technological goods, that's been one of the hardest hit. But many other things. I mean, it's apparel, it's textiles, all sorts of stuff. And so that's helped create a deflationary environment, which has then just been exacerbated, I guess, by this bond market, which has been contained, right, with all of the main players actually coordinating policy, and they were all sort of happy and getting along pretty well, and that's clearly not the case anymore. So that's all well and good, and then you ask yourself the question: okay, well, if you've got this market, which is essentially 63 trillion in sovereign bonds, roughly, only a trickle of that needs to start coming out, and we're seeing that for it to be a problem. So there's a couple of ways that you can play that. You can short those markets. That's difficult. When I say it's difficult, you're using futures or you're using options. Options have a problem with time decay, and futures have a problem with leverage. Often we'll look at these markets, and we come back to the sort of asymmetry. We say, how do we decrease the risk in any given setup? And sometimes, instead of shorting something, looking for the knock-on effects and going along something else is actually a better setup. And so we've been looking and saying, okay, well, how is this likely to manifest itself? And that brings me to something else which I've been working a lot on, which is, I'm going to call it resource nationalism. And I guess if we think, I mean, if people pulled up their Bloomberg or CNBC or any of these financial news reporting agencies at the moment, you'll hear all about Trump, for example, being a little bit upset about NATO. So we'll take that as a starting point. And so I think it was 2017, the US accounted for about 51% of NATO's combined GDP and about 70%, just over 70% of its defense expenditure. So in short, the US contributed more funds to NATO than Germany, France, Italy, Spain, the UK, and Canada combined, which are all the main NATO partners. So that's all interesting, and it's one of Trump's bugbears. The thing is, the US is no longer to be relied upon, and that Trump has made that pretty clear. The other thing to consider is that when the EU was created, many of those countries basically subcontracted out their military to a certain extent. They didn't require the border. Like, I mean, the whole concept of the EU was not to have borders within the EU, right? And so the military expenditure of all those countries declined. And it was sort of like, oh, well, Brussels will take care of that. And then Brussels was like, well, we won't really take care of it. We'll let the US take care of it. And so you've had decades and decades of, I guess, a lack of military spending within European nations. And if you look at what's taking place socially, the place is fragmenting. Austria's gone to the right. Italy's moved. Sweden's the right party are in the lead, and they got elections coming up. Merkel's on edge. I mean, she can't even form a government at the moment. It's very, very fractious. Anyways, the point is that we're going to have increasing political tensions within Europe. They've already conceded to not letting migrants cross borders. And I don't know how that works, because they've said, oh, well, we'll do it on a voluntary basis, which is just bullshit. I mean, what's going to happen is Italy's going to go, well, we don't really voluntarily want to have them in our country, so we'll push them over the border into Austria and let you guys voluntarily look after them. And Austria will go, well, the hell with that. We don't want to voluntarily do anything. And so you're going to have borders going to come back up again. And borders are useless unless you can actually patrol them. And so, and that's just sort of internally within Europe. But then you've got other pressures from Turkey, which has been threatening Europe, certainly been threatening Greece. And basically we're moving into a world which is going to be, we believe, much more security conscious. And I would not at all be surprised to see a military buildup. Certainly from Germany, they've got the most to lose. And we haven't seen that for years. So then you say, okay, well, how do you position for that? And you could go and you could buy military contractors and all that sort of stuff. The problem with them is that they're not particularly cheap. You look at the ratio, PE ratios or price to book, price to sales, that kind of nonsense. They're not particularly cheap, so they don't really get me all that excited. But one of the things that I've learned by reviewing history is that the first thing for any country to do, and this is going to be true of Japan, it's going to be true of China. In fact, it's definitely true of China right now. It's even true of the US with respect to the change in nuclear policy there, is that countries need energy security first and foremost. And that's going to be a big issue going forward. So we are very bullish on energy, but really a lot of this all comes down to resources, and not all resources are made the same. Nevertheless, we believe that there's going to be a shift of capital for military build-up, for example. And also the other really cool thing behind this is that we're coming out of a 7-year bear market in resources, so they're cheap. Again, not all are made the same, but very, very cheap. And I talk about energy. You look at the energy space, and like we've had, in Europe in particular, has been fascinating. You've had a decrease, for example, just pick uranium or nuclear as a starting point. They've been getting rid of all of their nuclear facilities. Germany, in particular, is by 2020 they're going to get rid of all of them. And I think that we're going to start seeing a change there. All of that kumbaya, rainbows and unicorns, we're all going to get energy from organic, bottled, positive thoughts, all that sort of hysteria, I think is going to go away, and we're going to have a catch-up. And it's going to be me first and get security. Security of the nation is going to be paramount. Now, I don't know if Germany would turn their reactors back on, but they're certainly going to start looking to have energy security. They can't necessarily rely on the US. In fact, the US is a bad place for them to get energy from anyway, because it's way more expensive. But then at the moment, they're basically at the behest of France and Russia for much of their energy. So Germany's actually, over the last 2 decades, really, really gone backward in terms of energy security. And that's all fine when your neighbors are getting along with you, and it's not so fine when they're not. And we're moving into the stage of trade wars and things of that nature. So
Chris, I wanted to ask you a question, because when you say energy too, because you have an amazing post on your blog, and I love reading your stuff on capitalist exploits, because it's always a different opinion, right? It's never the status quo. It's never something that you're going to read every place all over CNBC. But one of the things that you said about oil, which relates to this, which I wanted to bring up, is an article you cited. Basically, we're saying that despite much higher oil prices over the past year, most companies, and these CEOs have actually come out of major oil companies, they're hesitant to spend on new projects to find oil, since they're worried that maybe the price could come back down. And in turn, that's really going to create a shortage in oil, thus making prices rise even more. Now, when I hear that, first thing that comes to my mind is, are we overanalyzing this? Is this something that's actually true? Because usually what happens, we have more prices, more demand, higher prices spurs more demand. But yet it seems like these guys, and you talk about an industry, which you know about, Chris, where these guys don't invest for tomorrow, right? This isn't like technology or things like that. These guys look at a 10-year plan of the major oil companies and go from there. So is this going to also factor in, because oil prices seem like a good play on what you're saying with everything happening in Europe, then go a lot higher, and then you have higher oil prices, but yet these guys are really refusing to drill. If that's the case, is that one of the ways that you would play this also in oil, or is it just more about uranium? Yeah.
Oil's look, in the oil space, here's some basic numbers. We haven't had any exploration basically since 2015. There's been no money spent, like none, zero. If we just took offshore still accounts for 30% of global oil supplies. 30% is a lot, Frank. And in that space, something like 80% of the companies don't exist anymore. They've just gone away. So if you take offshore drillers, if you take offshore oil service companies, things of that nature, which we've obviously spent a lot of time on and were very long, but there's been just no money spent. And if you're an executive at any of these companies, firstly, you've typically, if you're still around, you've been through a bankruptcy. All of the debt holders have become equity holders. And if you were to go out and spend money now, where are you going to get it? There's not. So, like, some of them have got cash on their balance sheets, but these guys have been decimated. To get a board, to get shareholders on board with you going out and being expansionary is just a very difficult thing. It's psychologically very hard for people to do that. And so and even if they did, there's so few of them left, it wouldn't really make all that much of a dent at this point in time anyways. So that's a really interesting, like, again, we're always looking for asymmetric ways, and it's like, it's not really good enough just to say, oh, well, oil's going to do well, or oil's going to do bad. It's like, well, that's fine. But if oil goes from, say, 75 to 90, right, or let's just even 100, well, I mean, you could go and you could buy an ETF or something, but you're not going to make that much money. Big deal, you make 10, 15%. I mean, it's not really what we're here for. So you try and you look through and you dig into the whole sector and you see where the asymmetry lies. And so again, I come back to what I mentioned before with respect to the lowest risk. So when in offshore, many of these companies have got very strong balance sheets. I mean, they've gone through bankruptcy, so their debt. Look, think about it. This is a really capital-intensive type of business. So when you get a setup where you have this massively capital-intensive type of business, and the companies don't have debt, that almost only ever happens at the bottom of a cycle when all the debt that used to be there has been wiped out. Or should I say the shareholders or the debt holders have been wiped out, and they've become equity holders. And so even if you're wrong, it's like they're not likely to go anywhere. I mean, I could sit down and I could show people some of the metrics before, but you can have oil go from, let's say they went from 75 to like 60, and most of these things won't move. Because firstly, no one's looking at them, and secondly, they're actually making money at current prices, really just because their OPEX has collapsed, and their debt stack's imploded, and so it's all been converted. So that paints this picture of this very low risk side of things. And then, of course, if you have a narrative change in the market, and it's one that I just mentioned before, I think that we're going to have politically security of energy, security of everything, but security, the first thing any nation needs is a security of its energy supplies. And so that's going to become a very big factor. China's really been building strategic reserves because they don't have their own energy. And it's also one of the reasons why they're have an alliance essentially with Russia, which is very energy rich. But you're going to see same thing in Japan. I mean, like, everybody made this, and we kind of come back to uranium. Everybody made this case that uranium was going to be gone, and the Japanese were one of the biggest, and they're going to turn their backs on it. And that's just not the case. It's forgetting how politically charged energy is. You don't have a country without energy. It's that simple. Well, you don't have an economy without energy. You have a country. I mean, there's countries in Africa without energy, but they're not places that you and I would want to hang out in. So there's multiple factors which are all coalescing that make energy and traditional energy, fossil fuel energy, because the base load power of it is far better than many of the alternatives, is a place that we want to be. But it goes a lot deeper than that. It goes into many other resources. And, I mentioned, I've grew up in Africa, and I hate to say it, but one of the places that I'm incredibly bearish on is South Africa. It's very sad what's going on there, and it's largely unreported. And South Africa's 30 years behind most of the other Southern African countries that tried and failed with Marxist socialist policies. And that's interesting because things like platinum, palladium, all come from South Africa. About 90% of the palladium market is from South Africa. And palladium is not going away so long as, it's just not going away. And I'm going to dig into all of the metrics of palladium, but these are the sort of markets that we look at. And as I mentioned before, Frank, I'm sort of a generalist, so I have to get people on my team that can help in that respect. And one of the things that we started looking at was we needed to find somebody that was an expert in the resource industry. That was someone that had gone through financing, that understood the financing world, but someone that was technical and could understand geology and rocks and all that kind of stuff. And so we brought someone on. I was going to say recently, but it's been over 6 months. He's been on board, Jamie Keach, and he's there to ferret out and be able to understand specific companies within sectors. I can make a sector call and I can dig around and have my analysts look at stuff and figure that out. But when it comes to resources, is a difficult one because it's not just about a balance sheet, or an income statement, cash flow statements, and things of that nature. It's much more complex. And in some ways, I love the commodity space because it's so cyclical. And in other ways, I hate it because it's just half the time it's bloody holes in the ground, which mean nothing to me, And so I knew that I needed to bolster out that side of things. And to be honest, I think it's something. And I said this to Jamie when he joined our team. I said, we're going to do this for probably maybe 5-6 years, depending on what the cycle, how it pans out. But then we're going to shut it down. And he's okay with that. So, and the reason we're going to shut it down is because at some point, I want to be short. So, yeah.
No, well, and I want to move into this because Chris, and once again, guys, we're talking to Chris MacIntosh, founder of Capitalist Exploits. And you can see how much research, Chris, you put into just a thesis when it comes to, Europe, military conflict, energy needs, and building it down all the way to resources, which is basically led for you to create a brand new product. Like you said, you wanted to hire the right person who looks at geology and everything like that and understands the financing behind this. One, I want you to talk about that product. And then two, when it comes to this industry, a lot of people have tried to time it over the past 2-3 years and have gotten smoked. What makes you think, and you always say, so you said something earlier, it's very important because I've learned my lesson too, especially when you're trying to buy something that's out of favor, you need the catalyst. Is everything in Europe going to happen to the point right away where this makes sense to buy now, or could it take a little bit longer? And what's a little bit of your thesis behind that, as well as get into your new product that you're launching?
Yeah, no, you bring up a really good point, Frank. So the catalyst, I wrote a piece in 2016, which painted a picture of what I called it the rise of the strongmen. And I kind of poked fun at Duterte in Philippines and a bunch of other people. And this was before Trump came in, and I kind of laid out all of the reasons why we were likely to see what was taking place in the Philippines manifest itself across the Western world. And I remember it because I had a bunch of people come back to me and think I was a complete loon, and sort of suggesting that the West was far more gentle or far more sophisticated, if you will. I can't really quite find the right word, but they didn't think it was plausible or likely at all. And I in that piece I said this is why Donald Trump's going to win. So why the probability of him winning is far greater than anybody anticipates. And he has all the factors and so on and so forth. And so that was 2016. If we go back and we have a look at the bond market, July 2016 was when we believe it topped out, that we had about 13 trillion trading negative. And the catalyst, the change, was political in nature. Brexit was the first little inkling that we had towards that social angst and the change in the zeitgeist. And it's not just about Britain. It's again, a lot of this is a construct of socialism gone too far, and it's a construct of the GFC and how that was handled. And I'm not here to argue whether it was good or bad, or like, I don't care. That's not the point. The point is to make money and to figure out what's going on. And so, people will often say, "Oh, well, you were a proponent of Trump." And it's like, no, I wasn't a proponent of Trump. I was simply saying this is why he's going to win. And like, oh, well, then you're supporting Hillary. I'm like, oh, shut up. I don't support any of them. It's just you got to focus on what is a probability and how does that manifest itself and what are the knock-on effects. And so the catalyst, we believe, was political in nature. The fundamentals for these markets have been terrible for a long time. And if you look at Japan as an example, the fundamentals for the Japanese bond market have been terrible for some long time, and that's been the widowmaker. That has smoked me. I can't think of any of the major, really well-known fund managers who haven't had a crack at that little boy and lost. And so the same has been true of the sovereign debt markets for at least a decade now. And so we believe that fracture is political in nature, and we're seeing it now, right? We're seeing all of that coming through, and it's just started off as a trickle, and now it's becoming a little bit stronger and a little bit stronger. What we're seeing in Italy is a perfect example, and I think the biggest risk lies in Europe, because they cannot stop quantitative easing because of the target 2 imbalances. If they did, they're going to cut off the banking systems or their ability to function. And then, like, part of being, if you and I were Italy, part of the whole agreement, if you will, is that we're kind of looked after by the ECB and the EU. And so, they're all a bit angry about refugees, and they're angry about a whole lot of different things. And remember, they basically, when the EU came in, they swapped all of their debt for euros, which then appreciated by about 60%. So they got a really raw bloody deal. And so they're kind of figuring this out, and they're trying to get out of the EU. Many of them, there's strong movements across Europe to get out of the EU. It's a very difficult process, and it's going to be very chaotic. But that doesn't mean it's not going to happen. As painful as it may be, it's happening. And so that's if the US, for example, wanted to help, much like in the GFC, they wouldn't be raising rates. They'd be ensuring liquidity into that banking system. They'd be keeping rates really, really low, and so on and so forth. But they're not. And so that's putting external pressure on the European markets. And we're starting to see that flow of capital coming out of the Eurozone. And when one of these things starts cracking, it creates pressures in the others. And I know, like, you've got a lot of listeners who are probably North Americans, and it's a popular topic to be short US and saying, well, they have these enormous debt levels and it's all going to turn to custard, and so on and so forth. And our belief is that you're missing looking at the whole forest. And yes, I understand all of the problems in the US. I understand the metrics. Yes, it's a problem, but before that is likely to happen, there's much bigger problems in Europe and in Japan, for example. And so we believe we've just sort of started this process. When that causes problems, and Europe first, the natural knee-jerk reaction is for capital to move to the US. And now there's a reason for it to happen, because you've got like yield differential. I mean, why would you own a German Bund at negative yields? Why would you own an Italian BTP at lower yields than a US Treasury? It makes no freaking sense at all. And so you're seeing capital shift, because the only reason people own BTPs is because the guy was backstopped by the ECB, and you go, well, what's the ECB backstopped by? Well, it's kind of like backstopped by the German taxpayer. But now the Italians are going, well, the hell with the German taxpayer. We don't want you guys anymore. And even in Germany, they're going, well, the hell with the Italians. We don't really want them anymore. And so you, like, that's you're already seeing the capital moving, and it's just going to accelerate, we believe. So that's the sort of tipping point. And then how
Chris, real quick to your point, because I'm asking you this for my knowledge, because I'm curious about it too, where like you were saying, between Germany and Italy, from what I've been researching, and feel free to crush me on this because this is right in your field, but their banks needed to get bailed out in Italy, and they needed help, and Germany basically said no, and the ECB said basically no, and it was, they were like, for me, it was, isn't that the reason why when things go bad, at least you have that secure system where if you were on your own, you didn't. And granted, maybe they shouldn't get bailed out, but the fact that they said no would lead me to believe that Italy will eventually, I mean, what's the point of being in the EU if something like that's going to happen when you can't have that to rely upon?
Precisely. And the thing is, Italy's actually figured out that they're the ones in control. It's the old, if you owe the bank $100, you got a problem. If you owe the bank $100 million, well, guess what? The bank has a problem. So Italy owes something like 438 billion, essentially, to Germany. And when you saw the Salvini turn away the migrant boats or refugee boats, whatever the hell you want to call them, what was that, 3 weeks ago, 4 weeks ago, something like that, that was a slap in the face, because under the EU regulations, they can't really do that. They said, no more, we're not having any more people cross our border. And I kind of sat there and watched, because the only tool that EU has, because it's a carrot and a stick, right? Human nature doesn't change. So the carrot was, well, we're going to provide you access to our markets. We're going to provide you with liquidity in the banking system. And that's the biggest one, is liquidity into the banking system. And that's also the stick. If you don't do it, we're going to shut off liquidity to your banking system. And that was the threat that was made back in, I think it was 2020. When did Greece start causing trouble? 2015. Anyways, and Italy basically did it and sat there. And guess what? They didn't turn off the liquidity in the banking system. And they're not going to turn off liquidity in the banking system, because if they do, then Italy, politically, if you and I were Salvini sitting there, we'd go, well, look at these. We just turn to our populace and go, look at these guys. They didn't look after us. So why the hell should we be involved at all? We'll just walk away. And it's going to be chaotic and it's going to be messy, but you know what? We don't care. We're going to walk away. And Italy's the third biggest member union. So if Italy leaves, it's like the EU is not at all what it used to be. And they've now just had a default on 438 billion or whatever it is. So, and ostensibly it would be it would be decimating to the EU. It would be decimating for Italy to leave. It would, so they don't want to have that happen, and so they're kind of trying to push and pull, but there's much more pull than push, because they need Italy to keep the whole thing going, and Italy's kind of slowly figuring that out, and so we're going to see more pressure. We're going to see more pressure from member states for the things that they want, and they're going to be breaking more and more laws that have been. I mean, that's been the case anyways, right? I mean, the whole Target 2 setup is when that was first put into place. There were all of these metrics that had to be met, and they've all been blown like long ago. And they go, oh, well, we'll kind of change that one, and we'll let you stay. It's like a naughty boy, and it's like, don't hit your sister. If you hit your sister, you're going outside. And then he whacks his sister. It's like, oh, don't do that. Next time, sister. And pretty soon the naughty little shit realizes that he can beat the hell out of his sister every day, and you're not going to do anything about it. And so that's kind of Europe, is where Europe's at. But the point is that it's politically fragmenting, and it's going to cause security issues. We're going to see resource nationalism, and and we're coming out of a bear market in commodities, we think that that is one of, if not the best asymmetric way to play that geopolitical environment.
So, Chris, when you decide and you have a thesis like this, you could tell based on your research, I was saying before, how you go all in and things like this, but you're creating a new product which is called Resource Insider. And guys, just to be clear, I mean, Chris doesn't, it's not like an ETF where whatever's hot, Chris creates. It's usually a product that, and not that you have a lot of products, it's more like when you really see something specific for investors to benefit, that's when you actually do it. And usually it's something that's incredibly out of favor, which sometimes is tough to sell, right? Because people want to buy the FANG stocks today, right? They love them. They want to buy them. They can't have enough of them. But, you're launching this product, which I know you're excited about, Resource Insider. Why don't you tell my audience a little bit about it?
Yeah, it's funny. It's funny you mentioned people not wanting to buy the FANG stocks. And I joked to Jamie, and it wasn't even a joke. I said, but one of the factors that we're going to probably use as a metric is when we have a lot of people really want the product. That's probably when we need to close it down.
I know.
And so look, as I mentioned before, we can go out, we can buy into the sector, and you can buy into particular minerals and things. You can buy a number of different companies. You can buy big caps and whatever, which we do. But I had an experience back in the 2000s. I had a really fantastic broker, a gentleman by the name of Paul Van Eden, who's now, I think he's running a company called Evrim Resources. And he stepped out of that space many years back. Anyway, Paul was, from memory, he had a science degree, I believe it was. A very technical guy. Not a salesman at all. And he was my broker just by fluke. And he was one of the best, if not the best broker I've ever had. And we went through that bull market of the 2000s through 2008. And most of my money that I made in that space was as a result of him and private placements. You would get warrants, and you would get, so like I probably got an extra at least 30% of my overall sector allocation there. And don't quote me on this, but from memory, I made about 4 times my money over the course of about 3 or 4 years. But about 30 to 40% of that money came from private placement, from the benefits out of private placements. And I wasn't, and so when I came out of that, I realized, shit, I actually screwed this up, because I should have done much more of that and less of just buying the equities and so on and so forth. And so, I kind of filed it away in the back of my mind, and I might be wrong, but we don't think so naturally, otherwise we wouldn't be doing it. But I believe we're entering that space again, and certainly companies are struggling to raise capital. Nobody really wants to know the space because we've been through a bear market. There's hardly any companies left in many of these sectors because they've all been restructured or gone away. And we have this geopolitical environment that I just sort of alluded to. And so we think the timing's really right. But again, like I needed someone like Paul. And it took me nearly 12 months of hunting to find Jamie. Because again, I mean, I kept getting introduced to, people who were sort of, dare I say it, marketers. And I was like, no, that's not what I want. I need a guy who wears boots and hard hats, damn it, and understands this sort of stuff, because I don't. And so Jamie came on board about 6 months ago, and like hard out for the last 4 months. And we've been putting together deals, and so it's quite simple. It's like I need to figure out how to allocate my money, and I needed his help. And then I look at it and I go, well, I can pay the guy like I would need to, which is a lot of money, and I can just do that, or I can amortize the cost of that and the rest of the team, by providing research material on the deals. And so all the deals that we're going to be doing, it's basically we'll be going in with members of the service, pari passu, into these deals. And we make I'm not going to promise they're going to work, but I've got my money on the line, and we're going to do everything that we can to make sure that, well, he's going to do everything that he can to understand the particular deals, and I'll do what I do, which is to understand the macro environment. And so that's pretty much it. It's not really complicated, and that's our thesis, and that's how we're executing on it. So, yeah.
No, it's great stuff, Chris. And I know that you've talked to me about it. And for me, when I mention other people's products, I don't do it often. And people know that. I've been doing this for 10 years. But you're someone who with a proven track record that's come on here before, and people could see the research behind it. You're not hiding behind an email that's randomly coming from somebody nobody knows. That's pretty exciting with a nice title. So that's why when you say you're launching this product, I said, yeah, let me try to get in front of my people. And you also offered like a really good price too. So I'm going to send everybody the details of that. And you have like a free report on the resource sector that, I'll make available to you guys as well, because that's just what type of person you are, where you want people to understand everything about the industry before investing in your product and in these situations, which is really cool. But guys, I'll put together that package and send it to you. This way you can get a better idea of where Chris is coming from, if that's okay with you, buddy.
Yeah, that's fine.
All right, Chris. So listen, we'll leave it there. As always, I appreciate you coming on. For me, always educating me, like you said. We always have that network of people out there that always write in and stuff like that. And I just enjoy talking to you. Love listening to your ideas. And again, I really appreciate you coming on, buddy.
It's always fun, Frank. I appreciate your time. Thank you very much.
Hey, it's great stuff from Chris. Yeah, I love having him on. Hardcore research analyst. Once you get caught up where, well, I'm listening to it, and maybe I don't look up some of the things if you don't understand it on Google. I mean, because he's a brilliant guy. He's not there. I love the honesty where, he's going to start a new product, which is called Resource Insider. And he's going to start it now, which from a sales point of view, again, it's like almost when it comes to, say, something like cryptocurrencies, right? I mean, the best time to start that newsletter was when most people started, not us, because we give a shit about our subscribers, but there was so much hype in September, October, November that everybody wanted in on cryptos, and then everybody got in at the top, and what happened? Everybody's sitting on massive, massive losses in the sector, right? We didn't want to do that. That's why we waited to get our newsletter out. Chris is like that too. And the fact that he's like, well, we're starting this product, which is great, but then we're going to see real demand maybe 2 years from now, that's when we want to shut it down, because he doesn't want to crush his subscribers, because that's what our business is about. Right? Some business it's just about sales. Look, we run a company. You have to generate sales and pay your employees. We get it. But you need to do the right thing for your customers. That's how business is. I know. I analyzed thousands and thousands of business over my career. Okay, it can't just be about sales and crushing people and not giving a crap about anybody, because eventually people are just going to leave, and you're going to get a bad name. They're going to, statistics, and everybody that hates a company will tell 10 people compared to, if they like you, they'll tell 1 or 2. So eventually that catches up to you. It really does. But Chris is starting that new newsletter, Resource Insider, which is also going to include private placements in resource stocks, probably a few different private placements than what I offer in Curzio Venture Opportunities. And I'm going to send you an email about it over the next day or two with a special offer that he's given just me for my listeners, which, I really appreciate because he's a good friend. So if you're interested, cool. If not, no worries. I mean, I won't go to their website or anything, sign up. This is going to be a special deal for you guys. But Chris is a great analyst with a great track record, and it's my job to put guys like this in front of you. So, even though it might overlap a little bit with Curzio Venture, I always want, if there's ideas in there that I know you can make money, and Chris has come on this podcast numerous times and offer you amazing ideas that even I didn't take advantage of. Now I'm starting to take advantage of a lot of these things. Again, it's my job to put guys like this in front of you, and I like Chris a lot, and that's why I'm offering that newsletter. So if you're interested, cool. If not, no worries, but don't go to his website and subscribe, because he's creating something special just for us, and I'll send you an email about it. So if you want in, it's going to be accredited investors only. Feel free to inquire more about it through that link, but make sure you use that link. This way you get, the best discount and the best price on that product. Again, I'm here for you guys. So if that helps, cool. If not, again, something I should, no worries. Now, let's get to my educational segment. If you're a Curzio Research Advisory member, you're about to get a really, really fantastic issue. Okay, we publish every month. I don't say that every month. I say it when I'm pouring my heart out. I'm researching. I'm writing something for 3-4 days, staying up to 2-3 in the morning, not realizing what time it is because it's just I'm so engulfed in something. And it's usually when it's about a topic that's different or contrarian from everybody else. Because when you have a contrarian opinion and you throw it out there, you better make sure all your facts are right, because you're going to have the world attacking you, because it's a different opinion from the rest of the world. It's just like a short seller. When a short seller comes out on something, the whole world, usually people along stocks, fund managers along, they go out and they attack. And more times than not, that short seller happens to be right, because they're doing a lot more research, which is required to prove that the entire world is wrong. It makes sense. But this issue, guys, definitely, you're a subscriber, read it. I'm not selling it. Just saying it's going to be really, really good, because I'm going to explain what the chances of the U.S. having another credit crisis in your lifetime, and if you're 95 and listening to this, I'm not talking about you. I'm talking about the people who are around 55, either close to retiring or recently retired. But the chance of the U.S. having another credit crisis, the odds, is 0. It's 0. I know it sounds crazy. I know you think I'm smoking something. Just hear me out. Just over the next 5-10 minutes, I just want you to hear me out. So I'm going to throw statistics and things at you, and you make your own opinion. You may send me an email, frank@curzioresearch.com. Frank, you're an idiot. You have no idea what you're talking about. Absolutely nuts. Because what I'm going to say is going to fly in the face of 95% of the newsletter writers in this industry who are saying that you better prepare. You're in trouble, which they've been saying for 7-8 years, in the face of the biggest bull market in history, right? Probably in a generation at least. Telling you, watch out, buy a cave. It's crazy. The banking sector, it's over. You're in trouble. Prepare yourself. ATMs are not going to work anymore. Just hear me out. Because we've come a long way since the credit crisis. And don't worry, I'm not going to go over the entire story again. I'm sure you know it by now. If not, there's 25,000 books that everybody wrote to make a little bit of money for themselves about the credit crisis. You can go on Amazon and buy them and read them. Have fun. If that's what you want to do with your free time. Because here's a few details behind the banking industry that you rarely see mentioned in the media or in the financial news industry. I mean, it's going to give you a better picture on why this sector offers an incredible opportunity for investors today or over the next decade. And again, I covered banks before. This is going to be different. This is more detailed. So late 2008, shortly after Lehman Brothers filed for bankruptcy, our government established the Troubled Asset Relief Program, TARP, that authorized the U.S. Treasury to purchase up to $700 billion in troubled assets, which is sitting on the balance sheets of our banks. It turned out to be about 400 and something billion after all said was done. They didn't use the whole 700 billion. So the program helped stabilize the sector, as did the Dodd-Frank Act. And this is a regulation that was signed into law. It was 2010, and essentially allowed the government to regulate financial institutions. And by regulate, they decided if banks could pay dividends and buy back their shares of these capital programs to investors, and they would determine that based on stress tests, right? There's a provision requiring the largest banks, those with $50 billion in assets, that's what it is now, to pass an annual stress test. So they must submit this data to the FDIC by April 5th every single year. And these results are published to the world between June 15th, July 15th. If you notice, they were just published not long ago, about 2 weeks ago. 34 and 35 passed. The Deutsche Bank was the only one that really failed. They all were able to, a week later, all the banks submitted a capital program about how much capital they want to return to investors, and most of them got approved, which is the following week by the Fed. This year's stress tests required, a little bit different than what I've been saying. This year, required that the banks have enough capital to withstand depression-like conditions. These conditions include, and listen to this, a 10% plus unemployment rate, a 60% plus stock market crash, a 30% plus decline in home prices, and a negative 5%, a little bit more than 5% plus in gross domestic product, GDP. Think about that. Because if you put these numbers in perspective, these conditions have never existed together in the history of America. Not during the Great Depression, not during a credit crisis, never. Those things never existed together. Yet, the banks are required to keep that much capital on their books to prepare for that, just in case. Think about that for a minute. That's like Apple. Now that they repatriated a lot of their money and brought it back, whatever they have, 200 billion, 250 billion, who's counting these days on the balance sheet. That's like the government going to Apple and saying, you know what? You have to keep at least 200 billion of that 250 billion on your balance sheet, and you can't spend it ever, just in case something that never happened in the history of the country happens over the next 10 years. Can't spend it, can't do anything. Nope, you got to keep it on the books. That's what you have to do. Sorry, those are the laws. There are 35 banks that were required to go through the stress test I just mentioned, apart from Deutsche Bank. Each bank passed with flying colors. Again, this means that the banks were permitted by the Fed to return capital to their shareholders. Now, let's take a look under the hood at the actual numbers, which is a little important, right? Because these are facts, and it's important, right? It's not opinion. These are facts. According to the Fed, the 35 banks that went through the stress test added a combined $800 billion in high-quality assets, right? High-quality capital to their balance sheets since 2009. What does that mean, high quality? You know, cash on hand, government securities, as opposed to mortgages and credit card debt, right? So this is high-quality capital. Now, the Fed estimates that if the four conditions I mentioned, again, never happened in the U.S. ever, but if they all take place at the same time, our banks will lose a maximum amount of $578 billion. That's their number. They just said they have a combined $800 billion high-quality capital. What does that mean? That even if our country were to experience depression-like conditions, worse than the credit crisis, our banks are going to be perfectly fine. They're still going to have plenty of capital on the balance sheets, over $220 billion, to continue lending and doing business. Getting back to high-quality capital, that's just one stat. In 2014, a new measure was put in place to make sure the banks had enough capital on hand to withstand another credit crisis. And it's called Common Equity Tier 1 ratio. So it's CET1. Okay? Don't worry about calculating it. What you need to know is it's the best measure of a bank's core capital against its risk-rated assets. So it's basically the most important ratio to determine the solvency of a bank, all right? I don't want to get too technical. But what you need to know is when this measure was put into place in 2014, every bank was required to have a minimum CET1, and that's the ratio, of 4.5%. And that was by 2019. It was put in place 2014. So remember, 4.5%. Under that is bad, over that's good. So if it fell below that level, what would happen? The banks would not be allowed to pay discretionary bonus to employees, buy back shares of their stock, raise their dividend. This put the bank at a significant disadvantage to its competitors. Now, for the recent stress tests that were published like 2 weeks ago, the 35 banks reported, every one of them, a CET1 ratio well above 4.5%. If you're looking at the major banks, this ratio is 2 times to 3 times higher than the requirement of 4.5%. I mean, look at Morgan Stanley, 16.5, Wells Fargo, 12.3, Citigroup, 13, JP Morgan, 12.2, Goldman Sachs, 12.1, Bank of America, nearly 12%. Okay, again, it has to be up more than 4.5. And if you go from 2012 all the way through 2017, these banks significantly strengthened their balance sheets. And we're talking about being between 35 to 70% stronger than they were in 2011. Again, things people aren't going to tell you about. Now, if this is not enough to convince you that our banking system is perfectly safe, there's another number you should be familiar with. It's $351 billion. Because according to the Fed, the 35 banks, those large cap banks that just passed the stress tests, they have $351 billion in excess capital on their balance sheets. So this is money just sitting on the books to safeguard against a potential super depression. Now, of that $351 billion, over $200 billion excess capital is sitting on the balance sheets of basically just 7 of the largest American banks. You know them: Wells, Bank of America, JP Morgan, Citigroup, U.S. Bancorp, Morgan Stanley, Goldman Sachs, right? Those are names you're familiar with. Those guys have $210 billion excess capital. Okay, this is money that they can't touch. They're not allowed to touch, just sitting there almost wasted, right? That they want to take a percentage of that and lend. Because it's crazy to be sitting with that much money. They already have excess capital. If all these conditions happen, they already have over $200 billion in excess capital, in high-quality capital on their balance sheets, right? As I mentioned earlier. That's how crazy our regulation is right now. That's why they want to dial it back. There's new laws enacted by a current administration. Just a little bit of a deregulation. Not too crazy. Helping out the banks to issue, more loans, make it a little bit easier, relaxing the restrictions just a little bit, which is a start, which is good. But what you need to know as an investor is our banks are safer today than any other time in history. But if you still don't believe me and those stats don't make sense, you really need to understand what actually caused the credit crisis in 2008, because not only those factors no longer exist, but most people out there do not understand. Like, they think it was subprime mortgages. No, it wasn't just subprime mortgages. I mean, you're talking about things that would have hurt the housing market, that would have hurt the banks a little bit. Not something that collapsed our entire, or almost collapsed our entire financial system. And what really crushed us was securitization. I mean, that's what banks were using to increase profits. What is that? It's the pooling of high-risk illiquid assets, which are subprime loans. They pool them together into one product. They're called mortgage-backed securities, collateral debt obligations. Again, even that part, pooling them together, if you look at the market and it falls and housing prices fall, it wouldn't be that big of a deal. It would be limited to maybe financials and housing, Wouldn't be that bad. Because by pooling these loans together, what did they do? They were able to secure AAA ratings, and this is where things get interesting. That's the safest rating for the industries, but that's AAA ratings for these assets. Nobody looked what was inside. Because after all, if you pool all these things together, the chances of thousands of loans defaulting at once is very minimal compared to just one or two. So credit agencies making a fortune, AAA, getting paid, and that's fine. Still, that's not what caused really the crisis. That's what led to it. Now, here's where it gets interesting, because financial institutions weren't just selling these crazy products to third parties. They were also investing in them. And since many of these assets were held off of their balance sheets, which is, shadow banking, it was impossible for anyone to measure the actual true risk of this. That's why nobody knew what the hell was going on. Right now, we know everything. We have all the numbers in front of us. We know all the debt numbers in front of us. We see it. The banks are so regulated right now, they got, who up there, what. They can't do anything. We know exactly what they're doing right now. Back then, nobody knew. Nobody knew about this stuff. Now, here's where it gets interesting. This is why it crushed the markets, and it led to systemic risk, which is a collapse, everything linked together. Because what these idiots did is a financial institution, they got greedy and started leveraging these loans by an incredible 30-1. And this means that the banks are borrowing $30 for every $1 they invest in. So if you put that in perspective, I mean, all you need is home prices. If you're only putting up $1, right, and you're borrowing the rest, that much, leveraging 31, you're looking at a market that if housing prices fall 4%, you lose your entire equity. You lost all of your equity. You're done. So you just needed a small decline because they were leveraged, because they created synthetic loans. So it wasn't just, subprime, they lent to subprime or risky borrowers. No, that would have been limited to one market if that crashed. It was that they leveraged the hell out of it, placed this stuff in areas no one knew. And then when, they were liquid and some of them saw the market crashing, they went to AIG, tried to get insurance, and AIG had no clue what was going on. They're like, wow, look at all these people giving us free money. Sure, we'll insure everything. Okay, fine. All at one. So, obviously if AIG goes under and all these things crash, you look at the entire banking system, they're done. They're gone. Even if they're insured. If you're insured, your house burns down, your insurance company goes out of business, you're not getting any money. You're done. So this is what you need to understand what happened during a credit crisis. Some of you do, but I guarantee, or I bet most of you don't. Because if you did, you wouldn't think that a credit crisis is on the horizon. Because what you saw then is what? Home prices just started to decline. Every major financial institution got crushed. The credit markets froze. The global financial system began to fail. And that's why our government had no choice but to bail out the banks. Nobody likes it, but they had to, unless you wanted to see the end of Western civilization. 30% unemployment, still probably would have had 30% unemployment today. No jobs, no nothing. Again, it's hard to imagine what would have happened, but you're looking at no lending, no loans, no nothing, which is crazy. And you look at Steve Eisman, right, which is the guy who was in The Big Short. It was Steve Carell. His real name, Steve Eisman. And he was happy because he hated the banks. Even today, it wasn't long ago, he said that there's zero systemic risk in our system right now. You know why? Because our banks are no longer leveraged 30 to 1. They're leveraged at 10 to 1, which means it's almost impossible to make a run on these banks right now. And that's the lowest leverage, to put in perspective, the lowest amount they've been leveraged in decades. In decades. Even in 2002, it was like 15 to 1. It was 20-something to 1 in the 90s. Not only are they not leveraged, they have a watchdog that's watching them every single year with these crazy stress tests telling them, nope, you have to keep this capital on your balance sheet. But yet you have so many people out there saying, the market's going to crash. We have another credit crisis coming. We don't have another credit crisis coming. Could the banks fall 10, 15% for you? Absolutely. We're not going to see a 70, 80% crash in the markets. I mean, think about it. Use your common sense. What happened last time the markets crashed? The government bailed everybody out. And what happens? They made more money than ever. Everything, AIG, Fannie, Freddie, they made more money than all this stuff. Made a fortune. Well, banks are making a fortune. Everyone's able to pay back the money they borrowed during TARP. If we see a 20, 30% correction, you don't think that they're going to do that again? Do I like it? Do I agree with it? No, but I'm talking from an investment point of view. But again, could the banking stocks come down from here? Yeah, probably, but I doubt it with the amount of catalysts they have. They're unbelievable catalysts. I know people are going to shout out, Frank, we have $20 trillion in debt. It's crazy, more debt than ever. But they're not going to mention that homeowners in America are sitting on nearly $6 trillion untapped equity in their homes right now. Going to mention how $1.4 trillion in student loan debt's out of control. We could all see that number. We know what it is, but it's out of control. Not going to mention that this is guaranteed by the government, which has a printing press. We're fine there. It's going to be okay. It's not a big amount in the scheme of things. You're going to talk about how the auto loan market, $1.1 trillion, and how, whatever, 25, 30%, throw whatever number, is subprime. So it's the housing crisis all over again. It's not the housing crisis all over again. Anyone who bought a house knows if you buy a house and stop paying your mortgage, you know what? It's almost impossible to kick someone out of that house. And they could destroy that house and do whatever they want. And the fact that they had no equity because they just needed a library card, they just walked away. Today, most people have tons of equity now. They're not going to walk away. Even if housing prices crash 20%, they still have a ton of equity. They're going to be walking away from money in their homes. 95% plus pay their mortgage. You try not paying your car loan. What's going to happen? Skip it for 3 months. You'll see what happens. Your car's not going to be outside. It's going to be repossessed. And they're going to clean it up and sell it to somebody else. It's not a total loss or a wipeout of a massive loan like you saw with housing. They'll get money back for that. Believe me. And guys, again, you borrowed money for the car. They have your address. They know where you are. They'll repossess your car. People don't want to tell you that because it's not exciting. But enough's enough with the BS, where ATMs are going to stop paying you cash and the world's going to end, which has been told for you that, 7 straight years, which kept you out of the biggest bull market in stocks in a generation? And most of the people making these predictions either, don't know shit, or they're either trying to sell you something because, whatever, but they just can't simply read a balance sheet. Looking at the numbers, record earnings. Banks are going to report record earnings this quarter too. And forget about tax reform because they're the biggest beneficiary of tax reform because they pay some of the highest taxes out of every sector of the banks. But even if you took that away last quarter, they still would have reported record earnings, which is like a neighborhood of 45, 50 billion dollars around there. And I think 6 or 7 billion came from tax reforms. If you take that away, it was still record earnings. So if you're 55 and older and you're worried about this, which I don't blame you, right? I mean, it makes sense. I understand why you're worried. This didn't happen too long ago. You're just sitting there. You're retired. You're sitting on a nice nest egg. Your 401k suddenly declined by 40%. Your home price fell by 30%. And you're, 65, 70 going, oh, my God, am I going to have to work again? What do I do? I get it. But, guys, that's not going to happen again. If you look at the market today and what caused a credit crisis, again, something that happened for the first time since the 1930s, Those conditions don't exist. The banks aren't leveraged the way they are. I mean, even Eisman said it would take a media to bring down the banks now because they're not leveraged that much. It's important for you to understand that because all these debt numbers, they're in front of us. We see them. People don't want to talk about the equity. People don't want to talk about their assets. You got to look at the whole picture. That's why the chances for another credit crisis in our lifetime is zero. It's zero right now. If you don't believe me, that's fine. Go buy yourself a cave and live in it for a couple of years. I'm going to have fun with my life. That's your choice. But if you look at the numbers and you look at the conditions and you take time to do your own research, you're going to realize that. Is that going to sell me more newsletters? No, nobody wants to hear that. They want to hear that fracking kills animals and creates earthquakes and kills everybody and stuff like that, even though, all this water contamination, even though fracking doesn't cause water contamination. That's impossible unless water travels, from 5,000 feet upward, 4,500 feet into water somehow. Defies the law of physics. It doesn't happen. But be careful of the things you read out there that are meant to scare the shit out of you because they're selling a product. This isn't a friend that you know is an economist that's telling you, hey, board up your house. Things are bad. No, this is some email you're getting from a source you don't even know. And I hear people citing this stuff. Man, I don't know. I'm taking my money to the bank. The ATMs aren't going to work. I'm like, are you effing kidding me? You really think the ATMs are going to work? The banks are stronger today than they've ever been in history. So you need to buy them. And there's plenty of catalysts. I mean, plenty of catalysts for these banks. You're looking at just, higher interest rates. It's going to result in higher net interest margins, much stronger profits, huge increase in buybacks and dividends. And talk about billion. These guys are buying like 5, 7, 10% of their float this year, and it's going to continue year after year. That's how much money these guys have. And they're going to raise their dividends to levels that are higher than consumer staples and utilities, which are much, much more expensive, trading at 20 times plus earnings. The banks are trading at 12 times earnings. And they have huge growth potential. And they're going to pay higher yields. Why would you own consumer staples and utilities instead of the banks right now? You have deregulation, more deregulation coming. I mean, being able to put $350 billion excess capital work. Is it going to happen tomorrow? No. The banks come down a little bit more. They're going to report record earnings. Maybe you see them sell off a little bit. But man, if you're a growth and income investor, how aren't you investing in this? And again, maybe you just hate the banks and that's your personal feelings, and I understand that. But we're just talking about from an investment standpoint. And then what do we have with tax reforms, which is not a one-time thing. And banks, the biggest beneficiary almost of any other sector, they pay the highest taxes, and you're seeing that already. This is going to add tens of billions in free money to the balance sheets of these guys. It's going to flow right to the bottom line just because their tax rates are lower, which is going to continue going forward year after year. It's not a one-time event. So if you're looking at the banks, they have growth catalysts. They're trading at a dirt cheap price and much better alternatives than almost anything you could think of. From a growth and income standpoint. If you're 55 and older, again, stop worrying. Be smart. Doesn't mean the market can't come down 15, 20%. What I'm telling you is that systemic risk is completely off the table. We're not looking at 50, 60, 70% downturn that the whole world is tied together that nobody knows about. And even if that does happen, you have the government there that's probably going to bail us out from an investment standpoint because they made so much money the last time they did it. So the reason why you love me is now you can sleep at night. But do your own homework, do your research. If you want to email me that, that's frank@curzioresearch.com. That's frank@curzioresearch.com. And guys, thanks so much for listening to this podcast. I really appreciate all your support. That's it for me. I'll see you in 7 days. Take care.
The information presented on Wall Street Unplugged is the opinion of its hosts and guests. You should not base your investment decisions solely on this broadcast. Remember, it's your money and your responsibility. Wall Street Unplugged, produced by the Choose Yourself Podcast Network, the leader in podcasts produced to help you choose yourself.